Hey guys, well, I'm here with our illustrious loan officer and mortgage broker, Evan Einhorn with Modern Home Lending. How you doing, Evan?
Good. Good, good. How about you?
I'm doing great. I'm doing great. So today, just to kind of give you a quick framework, we're going to be talking about some different loan programs and about the housing market right now and mortgage market in general. So this will be our kind of our weekly market update all in one with Evan, who's an expert in the mortgage industry. He actually owns Modern Home Lending, which is a broker. And you want to explain that a little bit real quick, Evan, and a little bit about your company?
Yeah. Yeah, we're true mortgage broker, so over 30 lenders. And I think last year we used like 14 different lenders. So there's never going to be one lender that fits all. And happy to be a broker for our clients, for ourselves. It's just good knowing that you're getting the client the best deal.
Yeah,
Yep.
absolutely, absolutely. No junk fees, and he shops the best rates for you in loan programs, so it's nice. You're not locked into one thing. So, anyways, what do we have first, Evan, on your
Yeah.
list there?
So I'll share my screen and we can kind of start going through things.
Yeah,
So again, market update because there's a lot going on. There's been a lot going on the last 5 years. I mean, we had
yeah,
COVID. Rates actually started going up at the beginning of COVID. A lot of people don't know. Government got involved, dropped rates, had a crazy couple years. 2022 market slowed down, came back, slowed down a little this summer, but I feel like we're coming back again, where it's getting hotter, but we'll kind of get into that.
yeah,
Um, so I will say just in general, I do see a lot of information both ways. You hear information, sky is falling, you hear information, market's great. There's a little truth to both,
yeah,
um, but there's way too much fear, in my opinion, out there.
yeah. And
So,
context is key, right? Yeah,
yeah, yeah.
eh, yeah. It's funny, but so.
So,
Foreclosures are way up. This is one thing that we hear a lot
the
about.
fact,
Yeah, it's a fact
technically,
technically because we were starting from nothing, right?
yep,
After COVID or during COVID, and up until what, about a year ago when the forbearances kind of went away, right? Or year and a half ago, whatever it was.
yep,
So when you're starting with nothing, obviously they've gone up percentage wise, but actually we're still lower than pre-pandemic levels.
exactly, exactly. I think we're
Uh,
like three times the amount of foreclosures as last year, but less than 2019, less than 2018, less than 2017, like on and on and on. So, those are the facts. Foreclosures are up, well below before.
yeah.
Insurance costs are up. And there are some people that are struggling to pay their mortgage because of insurance, but most people
Yeah.
are paying their mortgage on time. And then, it's so real estate's so local, I put on here. In the last month, we've seen pending sales up and inventory down. And then
Right.
nationwide, we've seen mortgage applications up. So maybe do you want to talk about some of like the condos versus homes and state by
Yeah.
state stuff that we see?
Yeah. So if you're in like Florida or the Sun Belt, obviously there's more inventory there than there's going to be in other places. You've got the risk of hurricanes, in some places down in the South. Um, and you've got those insurance costs are a real big deal right now for those people. And a lot of properties are just sitting longer. People maybe aren't ready to take the risk for those sorts of things or pay those numbers. But one thing that came out this week that I thought was a big headline out there, and you guys got to keep in mind, people who are out there doing news look to get you to click on stuff. So, for instance, Zillow, who everybody knows Zillow, right? They had a thing out where, home prices are falling and, foreclosures are up and all these things, but they're lumping in single family homes with condos when they're giving you their stats. It's a really big distinction because they're two totally different markets. It's kind of like the resale market and the new home market are two totally different markets in many ways. So context is key, and when we look at those numbers, there's no sky falling as far as single family homes are concerned. But the condo market is struggling, even here in the Phoenix area. It definitely is struggling. And we have more inventory, nothing crazy, but we've had an influx of inventory over the summer, like in the Sun Belt. Not so much in the Midwest or Northeast, though. They actually need more inventory up there. So that's also another kind of thing where you hear we need more inventory, but a lot of that is Northeast, Midwest, more than the West or Sun Belt in the South.
Yeah, it, it
So
it varies a lot,
yeah,
and I've seen, and it's not, state by state, city by city, we'll get into a bit, and even like
yeah,
condo complex to condo complex. And I say
yeah,
that just because there's some condo complexes that you used to be able to get any type of loan in, and now you can only get specific loans. And I
right,
feel bad because I have a client in Glendale. They bought their property for 275 and it's probably worth like 230 now.
yeah,
But that's a very specific situation because the actual HOA is not well managed there. So that's something when
yeah.
you're buying, Chris and Cindy, I can help you look at.
Yeah, that's a big deal. Just really quick on that point, Evan. That's why it's so important to get pre-approved up front, right? Because we want to make sure if you're looking at condos or single family homes, that home qualifies for your mortgage that you're pre-approved for or that you chose to go with because of the rate or whatever, right? So, um, for instance, with the condos, a lot of them aren't maybe up to date on some of the forms they need to fill out, so they don't qualify for FHA, for instance, right? Wouldn't that
Yep,
be,
yep, yep, yep.
yeah,
Um, or depending on the amount of reserves they have, you can go conventional, but you have to put 10% down. You can't use one of the assistance programs or 3 or 5. So, that does limit the potential buyers. So if you own in there. Now, I own a condo myself. It's now a rental. I make sure I hop on the HOA meetings to make sure our insurance is always good, and the
yeah,
HOA does everything possible to make sure. So there is some ways you can actively make sure your community is staying in good shape. And if you ever have any questions, whether you're buying or you just own a condo, always happy to share. Hey, here's the things that people look at, and here's the things that you can do within your HOA to make sure, hey, you're in good shape. Again, single
right.
family homes, those have HOAs, but those don't really impact your, you know, ability to purchase.
Correct. Correct. Yeah.
So,
So, yeah, so state by state, I mean, as far as mortgage demand nationwide, we've got mortgage application data is doing great the last 30 weeks, actually. The overall, it's been up. It was up. Do you have the other stats there from Logan that he put out, Evan? I think, oh, here it is. 2% week to week up, mortgage application data. And the reason why this is important, and I always mention it in our updates, is because it's looking forward to what the potential is of what's going to close in the next 30 to 90 days, right? These are people who have applied for a mortgage, got pre-approved. They're looking to maybe sell and buy or just buy. So, 25% year over year. Um, uh, to Year to date weekly readings is 16 positive, 11 negative, 6 flat. Like I said, 30 straight weeks of positive year over year data, 17 consecutive weeks of double digit growth year over year. Now, that said, you're working from like the lowest levels because of where the rates have been over the last couple of years. So since what May of 2022, right, when rates jumped and
yep,
things kind of slowed down a little bit. So, but positive, forward looking.
yep, 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 yep. And it is something, um, kind of like you said, this is a good indicator because these applications likely show September or October closings.
Right,
Meanwhile, when you look at the data today, unless you're looking at live data, which we'll look at here in a bit, like week to week, most national data is done from the previous month. So it's August right now.
right.
If you look at most national articles or headlines, it's going to be looking at July data. It's not looking at the week to week. And then this is even looking a week forward.
Yeah,
Um, so let's take a look at overall in the Phoenix market. I know this is something that, again, you track daily and weekly. Most people track monthly, if not annually. Tell me kind of where we're at, as far as what do all these levers mean? for the
So
Phoenix market.
this is where I nerd out, Evan. So okay, so it's between 90 to 110 is a balanced range on the market index from Cromford, our local
Okay.
guru housing gurus. So under 90 is a buyer's market, and
Okay.
between 90 to 110 is a balanced market, and over 110 is a seller's market. So right now we were at like 73 on this index. Now we're at 78. So things are slowly moving back towards a balanced market because we've got a little less inventory on the supply. The supply has dropped a little bit. We're at 98 right now. The demand has gone up a hair. So things are moving back in the right direction. But if you're a buyer right now, even if you're a seller and you go on to buy, you may not get as much in equity out of your house as you want to, but it's kind of like whatever market you're in, it's either usually kind of towards a seller or local community even. It's geared towards seller or buyer, right? In which way it's going to go. So the way I tell people is it's a personal decision, right? If you have enough equity and you don't mind maybe giving a little bit in concessions right now, awesome. You're going to get a great deal on the house you're buying though. You know,
Right.
that
Right.
that's that, or if we were in the other end of the market, you may go the other way. You know what I mean? So it's kind of a personal decision from that standpoint. Not that you're going to get soaked on it, but it is what it is right now, right? Because of the
Yep.
market we're in. Um, when demand and supply on the index are the same number, we will be at balance at 100. So anyway, that's kind of the long and short of that and where we are right now.
Okay. So inventory is healthy. Demand is still a little low, and it's
Yeah.
still a little buyer's market, but getting close.
Right.
Well,
And we were a little higher on supply, which slowed things down a little bit along with the rates and stuff. But now rates are coming down and there's less supply on the MLS. We're we're down we were up to maybe 26,000, 27,000 was kind of the high that we went to. Again, for context, during the crash, we were here in the Phoenix area at 58,000. So this whole we're gonna crash is not a thing. Um, and now we're at like 23,000 ish or so, today.
yeah, I'm
So,
gonna skip ahead two
yeah,
slides, but you know, this right here, so this is the national average for mortgage rates. Our clients often get a lot less, depending on their every situation is different, investor, primary, different credit scores, all that.
sure.
But I will say, just from the beginning of August till now, the average rate is more than a quarter lower.
Yeah,
And it doesn't sound like a lot, but just being out there, and if you are a buyer, you're like, hey, okay, things got cheaper, so maybe I will make that offer. That
yeah,
is getting a lot of people off the fence. And, you know, this partially is due to there's a, over 90% chance, according to experts, that the Fed will drop rates next month. So that's already kind of baked in. Now, we do expect this to keep going down. Depends on the market reaction, but that's what a lot of people are hoping. And, I think people are kind of getting off the fence. And, that's why you saw these purchase applications start to go up because it was a little slower, still better than last year, but it was a little slower towards the end of the
yeah,
summer, and it's kind of inching up now.
yeah.
So,
And along those lines, guys, really quick, if you can go back to the other slide, Evan, you know, the Fed policy kind of gives the market a direction to which way they're going to go. So they're signaling, okay, that last jobs report revision means because their mandate is full job employment and inflation. They're signaling we may do a rate cut. Now, if they do 25 to 50 basis points, my guess is that won't move the market crazy. But once we start getting past that 50 basis point drop, maybe later this year, if they do any more rate cuts, we'll start to see the bond market react more because the 10-year treasury tracks with the 30-year mortgage rate. We call that the spread between the 10-year and the mortgage rate. And there's usually, like Barry Habib says, it's usually between 175 or 1.75 to 2% difference in where the mortgage rates are
yeah.
historically. Um, so don't
So it might be a little roller coastery, but overall
yeah,
we do expect down. It
we're
might feel
trending
like
down.
this.
Right.
Exactly.
We're
Exactly.
trending down. A rate reduction cycle's on its way.
Yeah.
Yeah.
You can almost kind of see it, you
Yeah.
know.
Yeah.
So we might go up a little, but
Yeah.
So this is good. And I always tell people once you're in the home, we just need rates to be low for a day, you know, for you to refinance.
Right.
Not a guarantee when. I don't know if it's gonna be 6 months or 18 months, like when we're gonna be refinancing, but once you're in the home and have the rate, you can time rates perfectly. So, I have
Yeah.
some clients that, they might have bought right here. And yeah, if they bought a couple weeks ago, they could have got a barely better rate. It's almost impossible to time a purchase and rate, but once you're in the home, then you can time it perfectly because we just need rates to be low and then you lock it right then because it's easy. So that is one of the feedback I give clients when they're trying to time interest rates and purchase perfectly. Once
Yeah.
you're in the home, you have that flexibility.
Couple of points on that really quick, Evan.
Yeah,
Um, can I just throw out some general numbers and then you
yeah,
can correct
do
me
it.
if I'm wrong? Okay, 100 basis point difference if they got concessions or rates drop. Okay.
So what's 100 basis points for everyone to explain? Yep,
One percent, let's say 1%. I'm just using round numbers.
yep,
1%.
1%. Yep.
Okay. So if we're using the average across the country of a house price right now and it goes down that much, we're talking what, a difference of maybe what, 250 to $300 in a payment on an average loan?
So let's just say a $400,000 loan, and let's
Yeah,
just say we
that's
drop from 6.5 to 5.5. You're probably looking at about $300. I can calculate it here real quick.
yeah.
So that's big. That is
Yeah.
definitely big.
So people always
So it's
ask
about
me,
250, roughly
and,
250. Yeah. Yeah.
and people always ask me, and I've done this on other, we've done this on other homes we had in the past, but for me, if it drops 25 basis points, I would refinance.
Well, if you can cover all the costs,
For
so we
yeah,
have no processing, no underwriting.
right.
So if we can cover the title fees, which the majority of the refinances we look at, you break even immediately. So it
Yeah,
is a no-brainer. So like I treat my clients' loans like I treat my own. My
right,
first home, I refinanced 5 times. I know I sound like a broken record because I've said it a ton. 5 times from 2015 to 2020 at 100% no cost. And then I
right.
did pay points in 2020 because I'm like, it's crazy low. We might not be here.
Yeah,
But the first 5 times was 100% no cost. Broke even immediately, no fees. Great. If they drop again, I'll refinance again. You don't have to worry about like, oh, when, I want to wait for a certain time. You can take advantage. So I do have some clients that honestly are refinancing now because they may have bought before, up
hmm,
here. And they're already saying, hey, you know what? I'll save that 100, $200 a month. But we want to save more. So as they keep dropping, when there's a good time in the future, we'll do that again.
sure, sure. Yeah, and I have people always mention, yeah, but it restarts the loan. What would you have, say about that? Yeah, it restarts everything, but you're saving money. You could always put more money on your principal if you want, right? I
Yeah.
mean,
So
yeah.
we have
So
29-year mortgages, 28 mortgages. So people can do that. Um,
nice.
but what I typically tell people is you can reset to the 30 and just pretend like you never refinanced. Just keep
Right.
making this old mortgage payment and more will go to principal versus interest. So even though you're only saving a couple $100 a month, you actually might cut 3 or 4 years off your loan if you pretend like you never refinanced or use that extra
Right.
savings to live off of or pay off debt or other stuff. So
Yeah. And I don't know if I'm getting ahead of our slides here, but just for, if you're buying a home, selling and buying, whatever, now's the time to get what are called the buy down rates, which we'll probably talk more about in a minute. But right now, think more about this than the actual price, in my opinion. Unless you're doing a cash purchase, obviously that's totally different.
yeah,
So you can get great deals on your rates, bought down by the seller, or builder, whatever, right now. So
yeah.
yeah,
So I mean, let's say you do have a 6.5, you could have the seller pay for 4.5 rate for the first year, 5.5 for the second year, and 6.5 for the rest of the loan.
yeah,
We also have some options with a lender where we'll actually cover it on our end for certain programs where you get the 5.5 for the first year and you end up at 6.5. Again, I'm using average rates. These are not
right.
everyone's situation is slightly different, and we are lower than the national average. But it is nice to be like, okay, well, I do have some cushion going into the home for the first year or two.
And this is the thing too, as rates continue to drop, we're going to see builders ramp back up their permits more. Now that means that's, permit, so land, fresh land, dirt. So that means that's 1 to 2 years out where our inventory is going to look like fresh new inventory. Because remember, resale sellers, 70% of them are also going to be buyers. So that kind of eats up part of the inventory. But the reason why I bring that up is that helps to stabilize pricing, in the market. When you're getting that fresh supply, you have a little bit more inventory coming on. So that's really the way to get builders to build more and stabilize pricing if people are price sensitive. But the mortgage rates kind of drive a lot of that.
Yeah. And it's all relative area wise. I know we were talking state to state.
Yeah.
Wanted to share this. So everyone, you know, look at your city on the market. Where are you at? And
Yeah.
and even this is too general sometimes because you could have certain neighborhoods be hotter than other neighborhoods within the city,
Yeah.
or like we were talking about condos or single family. This is where we're at today. And I know, Chris, you were sharing that every single market has gotten hotter in the last month, except for
Yeah.
Maricopa, a little down south. They're still in a heavy buyer's market. And then
Yep.
Tempe, but that does make sense every single year because Tempe does heat up in the summer with the ASU students coming back and
Right.
parents, and then it does cool down in the fall into the winter. So
Yeah.
every single market's gotten hotter. So it's one thing is you can't really have a buyer's market and the bottom at the same time because once
Right.
you're past the bottom, and we're not at a bottom, but it was a slower summer. We might be towards the end of that now that
Yeah.
things are heating up a little.
Right. Yeah. Yeah, I think, right now the projections are still for the Phoenix area to end up around 3 to 4% growth in pricing for the year. We'll see how that goes. But Paradise Valley is at like 196 right now.
It's
So
very hot, very
that's
hot.
that's
We
a
see multiple
super hot.
offers
Yeah.
on 1, 2, $3 million homes. Yep.
Yeah, that's a super hot market. To put it in context again for you really quick, 2021 crazy market, that was up near over 400 in Paradise Valley and for most of the markets in the area. So anyway, you know, this kind of gives you a good glimpse of where
Yeah.
other cities are. So
Um, we have a lot of mortgage stuff to talk about, here. I'm gonna give a very high level and just preface it with like reach out for your custom situation because we have a really good grant program that you put 1% down and they'll match 2% up to 7 grand. So if you're buying a $350,000 home, you put down 3,500, they'll give you a $7,000 grant. There is an income limit on that one in the Phoenix area. I quoted that. It varies by county. Um, there's other programs where you can get up to 5 grand assistance. A little higher rate and does come in as a lien, but there's no income limit, you know. And then the last one is a solar assistance program where if you're buying a home and putting on solar, you can actually finance the solar, so you don't have to deal with a second mortgage, but you can
wow.
get up to a $13,000 grant. And through the end of the year, so if someone is looking to do this, there were some changes with the new bill that you can still get a tax credit. So the tax credit
Oh,
is up to 12 grand. So you buy the home and you have a tax credit, you could possibly get up to $12,000 refund on top of the $13,000 grant that you got because you're just financing
wow.
solar into the upfront loan. So these are three programs that you can buy with nothing or 1% out of pocket.
And please, before you sign anything for a solar program, reach out to us because I, we've had people who get like these giant, over 200. I had one over 300, almost $400 a month lease on a solar. Guys, there's programs out there where the price never goes up and it's under 200 bucks, well under 200 bucks for programs. You can also even install your own or have someone help you install it at like half the price. So please, before you sign any solar leases,
Yeah.
reach out to us.
Yeah, there's almost no regulation. I mean,
Yeah.
there are people out there that you can sell. You can open a solar company almost if you're a contractor and sell $20,000 system for 50,000. And
Yeah.
and unfortunately we see that, and it just hurts you down the line because you're not really getting the energy benefit. And now you owe more because you have the second lien on your house. This
Yeah.
eliminates a little of that because you're getting a $13,000 grant, you're getting the tax credit yourself, and it's financed in one loan, so you're paying it down. You don't have to worry about adjustable lease payments or solar payments. It's all in one. But again, reach out and we can always see. But if down payment's an issue, there's multiple programs to help you.
Yeah.
So, um, this is a huge one in my opinion. This is 100% underutilized. And there's a lot of opportunity that if you're willing to buy a fixer upper, even if you don't have the cash to fix it, but you have a contractor that you'd like to use, this is a huge opportunity, especially going back to what we were talking about here. Some of these
Hmm.
buyers markets or even the balance markets, if you found a home in Peoria that needs work, there are a handful of homes that the homes that need work are not flying off the market. You
Right.
know, give them a lower offer, get it under contract, and we can finance the renovations into the loan. So if you want to
Yep.
buy a $350,000 home and put $50,000 of renovation in it, and maybe it's worth 450 after, great. Like we will actually look at what the future value of the home will be. The funds do need to go straight to the contractor, so unfortunately, it can't go to you. So if you're handy, this might not be the best for you, or maybe it's going to a
Right.
contractor that and then they're going to do the work. But you can also choose what you want to do. I know a lot of buyers want, new, updated, easy move-in ready. Cool. You can do that with this program. Decide what you're going to do while you're buying the house, and just have one loan and not have to worry about how am I going to pay for it after the fact.
And Evan, on those, some of the outlying things too, besides renovations, what about like things like fencing or pools, spas? Does any of that come into play, or landscaping at all, or irrigation, things like
So
that?
pool and landscaping you can use on one of the programs, not all of them. Some other programs do consider it cosmetic, so it depends on if it's FHA or conventional and your credit. Um, Pool might be one that you might want to buy a house with a pool,
Right.
just because it is cheaper if it's already there.
Sure.
Um, but hey, you find a house that has a green pool that needs new pool equipment. Cool, that sounds good to me. You know what I mean?
Bonus.
And because most buyers would skip that, they're like, I don't want to have to deal with this. Seller's not going to fix it. Kitchen
Yeah.
needs to be renovated. The pool pump's done. The pool's covered. It's empty. It needs work. Cool, let's fix it.
And when you
So.
say based on future value, so if someone's qualified for, let's say, 500,000 and the
Mhm.
house is 450, um, what is, and let's say the value is actually 450 after the
Yeah.
appraisal, like what does that look like?
So if someone's buying a house that's 350
Hmm.
and they're putting 50 grand into it, 400, depending on the program, we want the house to be worth at least 400 after the renovation. So the appraiser will say, hey, here's what it's worth now. Here's what it'll be worth after the renovations. And then, but FHA actually does have some variance that it's okay if it's not 100%. So if you are doing some custom renovations that maybe make sense for you, but doesn't give you dollar for dollar value, that's actually okay on
Okay.
FHA. But most of the time, if you're buying a house for 350 and you put a low down payment and you want cash to renovate that home, usually you're having to go with an expensive renovation loan. This is a renovation loan that gives you one loan from the start, and you can buy the house and do the repairs before you even move in. Because
Okay.
that's also the not fun thing is I don't think anyone likes living through renovation repairs. And on one of the programs, you can actually roll in some of your payments, so you can wait to make your mortgage payments until you move in, which is nice.
Right. Okay.
So yeah. But again, don't be scared of homes that need work if you're going to get a deal on them. And in this market, when it's balanced or slightly buyer's market, those are the homes that are completely being overlooked. So,
Yeah, yeah, that's a big thing because you may be like, oh, this is ugly or it needs some work or whatever. This is a way of getting around that, and it's all factored in where you don't need to have necessarily all the cash to do it.
right,
You know,
right.
um, and that's usually what a little bit longer time to close on a property, right? Uh, can you?
Yep. I typically quote people say, hey, 45 days, maybe 60.
Yeah,
The biggest hurdle is just making sure you have a contractor, which Chris, I know you can recommend some,
yeah,
But
Yeah.
contractor and making sure you know what you want to do up front. Lots of times the delays are, hey, it might take a few weeks of back and forth or 30 days to figure out. I don't even know what kind of flooring I want to put in. I don't know what paint. I don't. Are we doing the counters? Are we not doing the counters? Are we painting the cabinets or are we replacing them? So if you kind of have a good vision in your head and you can meet the contractor once or twice in the first week or two and finalize those plans, then 45 days is no problem. I mean, technically 30 days could be
Yeah.
possible, but that's pushing it just because we'd be rushing you on decisions. So we don't
Sure.
want to do that.
Gotcha.
Yeah.
Okay. That makes
Yeah.
sense.
But yeah, great opportunity. Just especially in
Yeah.
this market, like finding a diamond, literally diamond in the rough and making it a diamond.
Yeah.
Um,
Great opportunity.
so other creative ones, not going to go too much in depth. We kind of mentioned this. Temporary buy downs, you can get a lower rate for your first year or two or 3 years. I actually have some options where, yeah, some clients are starting in the 3%, which is kind of cool. Um, there are some opportunities to have it paid for by the lender, or from the seller. But again, we can. So if you do want that lower first year payment, great, but you don't want an adjustable rate, there's an option for that. Loan assumptions, if you do have a little cash, this is a great opportunity for people buying to move into it or investors. I think this is huge for investors because
Yeah.
um, people would be looking in today's market trying to find a home that they can buy and cash flow. You can still find them, but this makes it a lot easier because you're taking over someone's maybe 2 or 3% rate. So
Right.
you can still do that. Usually it's the issue is just making sure you have a little down payment to match the gap.
Yeah. We have a
Um,
couple of ways of filtering those properties out between the MLS and a couple other companies we work with that could, filter all that out. And then you'll know, oh, this one's got a 2 or 3% rate or whatever. And we'll want to go after this one or that one.
yep.
Yep.
Yep. And then, they're not super popular. It's a super small part of the market, but it is something we've been talking to some clients about. ARMs, adjustable rate mortgages. I know they get a bad name from the crash because they used to be where they were adjustable from day one or after 1 year or 3 years, and they were negative where your balance would be going up. But we are seeing a little uptick in FHA and VA ARMs, so adjustable rate mortgages that it's still fixed for the first 5 years. So 5 years cannot change. Or conventional. There's other options, but these are the most competitive ones. Or on a conventional loan, it's fixed for the first 7 years.
Right.
So first 7 years, your payment can't change. The goal would be at some point you refinance out of it, or a lot of people sell within 7 years. So
Yeah.
a lot of people I know are not in the same home that they were in 2018. Kind of think of where you're at. And if you are, you probably don't have the same mortgage you are, in 2018 because you probably refinance at some point.
And is that like the temporary buy downs where you have to qualify for the higher uh end fixed rate too, Evan? Or in other words, like you said, a little bit more of a strict process than the crash products that were out there.
That's a good question. So, like on the government arms, we are taking into account and pretending like the rate's higher.
Yeah.
So it's not the easiest to qualify for. So they're not the scary arms where you're like, oh my gosh, you're putting someone into a home and that's going to change and they're not going to be able to afford it. One, the goal is that hopefully they don't have this down the line. But two, even if they are qualified at a higher rate. On the 7 year arms, they're actually qualified at whatever the rate is to start. But these arms actually don't make sense typically unless you're going to put at least 20% down. So
Yeah.
most of the
Gotcha.
times we're doing this, people with good credit, they're putting 20% down. But hey, instead of a 6.5% rate for the same cost, you might be able to get 5.99. Again, generic rates, not live, but that's a good example of, yeah, let's save a couple $100 a month because I'm not worried about, I do think at some point I'll either refinance, pay off the loan, or sell the house within 7 years.
Right.
That's when these make sense.
Okay.
So, but a lot of stuff, I mean, we've talked about a lot of stuff today, and we could talk for another couple hours, but just wanted
Yeah.
to tease this. And if anyone has any, specific questions, always have to talk about their specific situation. But I know you're going to be out this weekend. Was it Thursday, Saturday, and did you
Yeah.
say Sunday?
Yeah, we're going to be doing those are the times and dates there right in the middle end of the open house there where we're going to be, and the address is up on top. in Marley Park. I mean, that's a beautiful area. The cool thing about that area is the homes don't all look the same like all the other neighborhoods we see in Arizona. They have a lot of like giant porches, and kind of looks more like almost like you're up north, or in a back northeast type of setting. And a lot of this one in the front, not so much, but a lot of the homes in the area look like that from the exterior. But yeah, we're going to be there today from 1 to 4, Saturday 10 to 1, and then I couldn't fit it on here, but Sunday 10 to 2. It's a 5 bed, 4.5 bath. It's got a casita, uh, big yard, and it's got actually a total with the casita of 4 suites. So it's pretty massive. It'd be great for a family, or even kind of a generational type thing, or if you wanted to
Yeah.
use the casita as an office. But it's offered at 615. So yeah. One other thing I had, Evan,
Yeah.
for right now, actually two other quick stats. Right now we're running just over a 4 month supply on homes. So again, that kind of means we're kind of heading back to that
Is it in the Phoenix market or
yeah,
nationwide?
the whole Phoenix metro area.
Okay.
And our list to sales price ratio, I always like to throw this out, is still at 97. We like to see that about a little over 98%. So the closed days on market right now are running at about 81. So
So if someone's buying a $500,000 home, the average $500,000 home would be selling for about 485 and 3%
correct,
off. Okay.
correct.
Yeah, that makes
Yeah, and a
sense.
lot of that could just be concessions, not the price necessarily. Sometimes when people are getting those concessions, they might offer a higher price if they're in a competitive situation too, to kind of offset that. But yeah,
Cool. Well, thanks for sharing. It was
yeah.
good. We talked about a lot of stuff. Here's our information. You can always email me, go to modernhomelending.com. My number's on the screen, 602-456-2273. Call or text. And then Chris, your info.
Yeah, it's 480-788-8569, or check us out at mincolagroup.com or home@mincolagroup.com.
No. And again,
So,
always happy to do a custom purchase analysis, a buy versus rent analysis, because there's some clients that tell me, hey, we might only be here a year or two, and we tell them the rent or different situations. So
yeah,
always reach out and we're happy to, have a good
yeah,
heart to heart.
always happy to help. All
Yeah.
right, guys, we will see you next time. Thank you so much.
Thank you. We'll see ya.